Just for clarity, that's not. Is that a perfect spot? Good morning. We'll call meeting to order for the firefighters pension board at 10:01. Ms. Collins, take roll call, please.
Chad Ranford,
Here.
Ken Sundin,
Here.
Mark Lanaday.
Here.
Chair, we have a quorum. Thank you.
So everybody had an opportunity to review last meeting's minutes.
I make motion to approve.
I second. Motion by Mr. Lennedy, second by Mr. Sutton. All in favor? All right. On to Mr. Long. Captain City. Good morning, sir.
Right. All right, microphone is on. Dwayne Madron, Capital City Trust. And we'll go to the first page of the presentation, please, which is the asset allocation. So all of the asset classes are within the operating range prescribed by the policy. The policy also has a cap of 75% in equity. We are currently at 70. So we are under the cap. And so you'll notice we have a little bit of cash because equities have been expensive and still are. And on March 10th, I put 2% of the fund to work. So cash is now a little bit lower than it was, but still a little bit high. Cash earns 4.1%. So it earns about the same as bonds. And that's why I haven't moved it to bonds. And then you'll see that eventually when cash comes down, and it will, I'll move more money to Sawgrass because it can earn more. So having said that, there's no questions. We can move on to the two charts I would like to share with you. The first is a valuation chart on the S&P 500. Higher up on the chart means stocks are expensive. And you can see back in January how expensive they were, more than one standard deviation away from the mean. And then we had the correction in March and February. And now stocks, instead of being very expensive, are simply expensive. They're still about one standard deviation away. So the tariffs brought stocks down about 14% real quick. But then when President Trump announced a reprieve or a delay on tariffs for 90 days, the stock market took off like a rocket and now is almost back to where it was. So stocks are still expensive. We're still cautious. So I've got some dry powder to put to work in case stocks fall back. You please page down to the next chart. This is value versus growth. So lower on the chart on the left means that growth stocks are expensive in relation to value stocks. Growth stocks are Amazon, Apple, Microsoft, Tesla, NVIDIA, and any semiconductor company, for instance. And that's important because the technology stocks have been driving the stock market. That's been the great returns you've been seeing, I'll show you in a minute, have been due to technology. And if you see the green bars on the upper right chart are the growth rates of technology. And you see how they're falling. They're not as great as they used to be. And also the chart on the bottom right has the green bars are the growth rates of technology. You can see in relation to value, the black bars, that the growth rates of technology stocks are falling. And so that's a little bit concerning because that is what was driving the stock market. So we'll keep an eye on that. And if you want to page down to the account performance, we can look at the first quarter. So for the latest quarter ending March 30, First, the equity side lost 2.83%. Most of that was equity, pure equity. We also manage high yield bonds. So the stocks were down minus 3.49, but the high yield bonds doing their job as what bonds normally do. They go up when stocks go down. So the high yield bonds earn 1.57% and cash earn 1.12. So the negative number is largely due to the correction that started on February 19th and went all the way through March. So that pretty much has been erased. So as time goes on, you'll see returns get better. And if you turn the page, I have April's returns through April. So still negative because April had some parts of the correction. And so year to date, the account is down, the equity side is down 3%, but bonds are up 1.9. The stocks are down 3.78. If you look over the last 5 years, though, the equity side earned 12% per year. Stocks returned 13.2 and the high yield bonds returned 5.3. So longer term, it's been great because equities were great and they were driven by technology. So we'll see if that continues going forward. If you continue on down to the asset allocation part. So this would be the asset allocation as of, let's see, a couple of weeks ago, I believe. 60% in equities, 33% in bonds, and 5% in cash. And this does not include the infrastructure or the real estate. So if you include that, it's closer to the 70% equity. So still within the policy range. If you turn the page, you can see the holdings, which I won't go into detail, but you'll see Sawgrass is there. You can see the Vanguard and the Fidelity index funds, low cost approach to institutional investing. They do quite a good job. They track their indexes really closely. Well, that's and then fiscal year to date, sometimes I get asked this question, what is the pension fund doing fiscal year to date? From September till now, it's down minus 2.2%. Now that does not include Sawgrass. So I'm estimating that it's closer to flat, zero, because I think the bonds are in positive territory. And since stocks are -2, I think bonds are up about 3. So probably flat. Any questions?
This is just part of the whole bumpy ride that we have to deal with.
Yes, this is the economy slowing down because it's been in an expansion. Economies don't expand forever. They expand for a while, then they contract. Sometimes they go into a recession. Sometimes they don't. This time it doesn't appear like a recession is going to happen. But the economy is slowing down for a lot of different reasons. Part of it's because we imported a lot last quarter to avoid tariffs. And when you import a lot of goods, your growth number, the way they calculate it, the imports subtract and make the growth look lower. But unemployment is almost full. A lot of people have a job. Wages are going up in some industries. So I wouldn't say the economy's bad off, but it certainly is running at about a 2.2% pace, which is a little bit low. We'd like to see 3 or 4, but it's slowing down. That's compared to last year.
Thank you.
Any questions?
Any questions? Entertain a motion to accept the report as written.
Make a motion to accept the capital city report.
A motion by
I'll
Sugden,
second.
a second by Lenity. All in favor?
Aye.
Aye.
Thank you.
Sir. Thank you, sir. Next up. Mr. Brandt.
Good morning. Good to see everyone.
Good to see you, sir.
So we can start off in the handout and then I'll jump into the report. Obviously, a lot has happened since quarter end, so I'll give you a quick update through the most recent trading day, which was Friday. But on page 2, you'll see this chart here. So just to reiterate, we did see for the first quarter in a couple of years now, we saw the economy contract. And again, that was really driven by a spike in imports trying to get ahead of tariffs. So many companies importing goods to get ahead of those price increases from tariffs. And so you can see on the chart, the far right-hand side, really the only negative was from net exports. So again, we're not exporting, we're importing. So that was the big drawdown. The last time we saw a negative GDP quarter was first quarter of 2022. If you remember back, that was when we were starting to see a huge spike in inflation. So again, same thing, quite a bit of imports coming in to front run that inflation. Same thing here, but just with tariffs. If we go to the next page, page 3, despite all the uncertainty around tariffs, we have seen a very resilient labor market, which is a good sign. So for April, the unemployment numbers came in, it stayed steady at 4.2%. We grew 177,000 jobs. We did see a revision down for March and February, but overall, the last 3 months, the average payroll gains was roughly 155,000. So still very resilient job market. On the next page, page 4, highlighting here, and I actually have an update as of this morning. So the one thing that concerns us about the economy is the consumer. Really, the saving grace for the first quarter was consumer spending was up 1.2% quarter over quarter. And so that kind of buffered some of the contraction we saw from net exports being down. But if you look at the right-hand corner, the U.S. consumer is incredibly debt burdened right now. And the update I have of this morning, so you can see that chart in the bottom right-hand corner. This is percent of balances delinquent past 30 days. So it looks at auto loans, credit cards, student loans, and mortgages. You can see in this chart, 3 of the 4 are trending up significantly. So auto loans, 8%, credit card loans, 9%, mortgages creeping up to 4%. The one that's been static is that student loans. And here it says 0.9%. And I've showed this chart for the past few quarters saying, you know, the new administration is taking off the moratorium that the Biden administration had during the pandemic in terms of allowing individuals to not pay back their loans, to not start collecting those payments. Well, May 5th, the new administration announced that from the Department of Education, the Office of Federal Student Loans was going to begin resuming collections on their portfolio of defaulted student loans. So what's that number? That particular portfolio is about 4 million borrowers that are not just delinquent, but serious delinquent, so past 90 days. And so they started recouping those in May, the beginning of this month. And so the new numbers, that 0.9, while that doesn't sound too bad, as of this morning, the update was it's actually 8.2% of those loans are delinquent. So it means that we may likely, by technical definition, be in a recession. So technical definition is 2 consecutive quarters of shrinking economy, negative GDP. We already had the first quarter. We're likely to possibly see that again this quarter. The only reason we may not is we might, because we front loaded so much imports, that number might not be as negative, but I think we're going to certainly see consumers start spending less. And so that resilient consumer we've seen that just continues to spend, you know, the numbers from the previous Black Friday and Cyber Monday were all new highs again. I think 5 billion more than the year before in spending. I don't think we're going to continue to see that trend. And so as inflation continues to remain somewhat high, it's at 2.3%, came down a little bit from March for April, but still above the Fed target. And then the uncertainty around tariffs, we still have 35% on China, which is, you know, much better than the 145% that it was. But again, that's a significant increase from what we were paying originally. The markets were rattled at the end of last week because Trump, you know, stated that he was going to place 50% tariffs on the EU. Over the weekend, we got an announcement that that's going to be postponed from or delayed from June 1 to July 9th while they discuss trade policy. So the markets are back in positive territory this morning because of that. But again, just that uncertainty makes it hard for businesses to gauge their spending going forward, which means probably lower wage growth, lower business growth, because how are you supposed to kind of gauge if you're importing from China, if your goods are coming from China? you may have shifted that now, but there's tariffs across the globe. So where do you really go? Do you just kind of eat it? You pass it on to the consumer? So I think the uncertainty, as we get more trade deals in place and more certainty, that should help and should hopefully help recover the economy. But right now, the uncertainty is really what's spooking markets and really feeding into the negative news cycle as far as where the economy is. The next page, in terms of markets, on page 5, we actually saw the consumer sentiment index at, really its lows from back in mid 2022. And again, mid 2022, June specifically of 2022 was when inflation was over 9%, the highest level we saw during that spike. So consumers very negative on the market, but that's actually a good thing. And we've already kind of seen this play out historically when we see those troughs in consumer sentiment. We tend to see the markets rally pretty significantly off that. So we actually saw for May, markets rebounded all the way back up into positive territory. We ended last week slightly negative. As of this morning, again, we're bounced back just above positive territory for the S&P 500. Page 6, I won't go into too much, but the market volatility we saw in April on the back of, the Liberation Day announcement that, we're going to place tariffs across the globe and significantly on China. The market sold off by about 15% in about a week period. With that, we tend to look at, is this oversold? Is there panic selling? And a good indication of that is credit spreads. So high yield bonds, junk bonds, if their spread blows out significantly to investment grade and treasuries, then that's an indication that people are just panic selling all of their riskier assets and flooding into the safer assets, U.S. treasuries and AAA investment credits. We saw it widen, but not to the levels we saw in, for instance, 2020 during the pandemic or in 2008, which would indicate panic selling. So they were certainly selling, but it was pretty orderly this time around. And again, we've already rebounded from those lows in April through today. Next page, page 7. This is just a highlight looking at the volatility we saw to start the year. So again, really the genesis of the most volatility was April 2nd, that Liberation Day announcement, where you remember on the White House lawn with that big poster board that had all the scary tariff numbers. The following week, we saw the market sell off by about 15%. And then April 9th was when they came out and said, okay, we're going to delay this by 90 days. We're going to still keep the tariffs on China, but everyone else is dropping to 10%. That day alone, markets rebounded 10%. And subsequently, as we've gotten more trade deals in, so we got the trade deal with the UK, we got a temporary 90-day trade deal with China, again, reducing it from 145 to 35%. The markets have rebounded substantially. They finished last week down 0.8%. But again, as of this morning, the market's back up 1.4%. So again, back in positive territory on a year-to-date basis. And then lastly, on page 8, one of the interesting notes so far year to date is this is the first time in really about 17 years that we've seen international substantially outperform the U.S. So again, why we have a diversified portfolio where we have an international global infrastructure, some of the diversifying assets is, while it's been a trend for, again, nearly 2 decades, the U.S. doesn't always outperform international. And so this year to date and through Friday, developed markets, so excluding China, we're up 16.3%. Emerging markets, which includes China, was up 10%. And then the S&P, again, through Friday was down 0.8%. It's back in positive territory. But really the genesis of the U.S. underperforming, again, with the tariff uncertainty, is also the Magnificent Seven. So there's a large cap tech growth communications company. So Tesla is the big one that's sold off year to date. Meta, which is Facebook's parent company, NVIDIA, Microsoft, Apple, Alphabet, Google's parent company. Those are all on down on average about 4% year to date, some more than others. Apple, in particular, Apple and Tesla are down the most of those 7 names. Those have led the markets the past 2 years, and why the U.S. has outperformed significantly. You can actually see the chart on the right is if you take the S&P 500 and just take out NVIDIA, which is one of the best performers in 23 and 24, we would have actually underperformed regions like Japan and Europe. So those 7 companies are very top heavy in the S&P 500. It's a market cap weighted. So the larger they get, the more impact they have on that index. Because they're having a down year, the U.S. has trended down as well. And then I will jump into the report. There's a few more pages in the handout specifically about American Funds Euro Pacific, so I'll highlight that once we go through the report. But in the report, we can jump over to page 5. And so here for the quarter, and again, this is as of March 31st. So I've given you the highlights. We're likely back about flat year to date, maybe slightly positive. But for the quarter, we're down 122,000 or 1.1%, right in line with our strategic model, which was down 1.3%. And your best performers were, again, international. So your index fund there, the Vanguard Developed Markets International, is up 6.8%. Cohen & Steers Global Infrastructure, which has about, it's 50-50, so it's about 50% US, 50% international. That was up 5.2%. And then fixed income in a volatile quarter had a great return. Sawgrass was up 3.1%. Fiscal year to date, so this is halfway through your fiscal year as of this report, down 160,000 or 1.5%. And again, right in line with your strategic model at 1.6%. For the 1 year, so the 12 months, the plan earned 586,000 or 5.9%. And again, right in line with your strategic model and ranked in the top 43rd percentile. So outperforming about 60% of other public pension funds across the country. And your best performers were that Cohen & Steer Global Infrastructure Fund, up nearly 15%. The Vanguard S&P 500 Index up 8.3%. And then your convertible bond index fund, the Spider Bloomberg Convertible ETF, up 7.4%, as well as that high yield bond fund, the Vanguard High Yield Corporate Bond Fund, 7.4%. Longer term, the numbers look much better. So despite all the volatility, if we look at the past 5 years, and keep in mind that includes the pandemic, 2020 through that period, 2022 when the market sold off, again, kind of led by the Magnificent Seven being down during that inflationary period. You've earned $4 million over that 5-year period, averaging 9.8%, well ahead of your actuarial assumption rate over that period. Any questions on that before I hop down to page 9? All right, page 9 is a look at, again, as of the end of March 31st, how you were allocated versus your targets. Those targets are the gold bars, the blue is your current allocation. So again, across the board, pretty in line with your targets. Underweight U.S. equities, which was a good position for the quarter as markets were down in the U.S. And overweight fixed income, again, very good position to be in as fixed income outperformed for the quarter. As well as cash, again, had nearly that 5%, about 4% overweight to cash. Again, a good position to be in a volatile market when things are selling off. Cash, again, generating between 4 and 5% income on an annual basis. So again, good position to be in. If we go to page 12, so 2 of the areas I'll highlight of concern. One is more of note that's kind of an unexpected return. So if you look at the Fidelity small cap, down nearly 10% for the quarter, would not have expected that in a volatile period that was really built on tariff pressure, because traditionally small cap, smaller companies are more domestically focused. This is a U.S. index of small companies. Typically, they're less impacted by tariffs. They have less reliance on international suppliers. But unfortunately, it was more of a market where it's easier to sell U.S. equities, particularly index funds, and the riskier parts of the market. So the lower you go down in market cap, small cap, mid cap, those tend to sell off quicker than large cap, which are a little more stable. So somewhat surprised to see it down that much. It has rebounded, but that's an area we would expect similar to international, where we finally started to see it outperform. Valuations are so low on small cap and international compared to large cap in US. We would expect eventually those valuations to start mattering and small cap to outperform. So a little strange for the quarter, but again, just wanted to note that. And then at the bottom of page 12, American Funds Euro Pacific, again, underperformed for the quarter. You can see we've balanced that out with the index funds. We have about 2/3 in the index fund, the Vanguard FTSE Developed Markets, and 1/3 in the American Funds Euro Pacific Growth. So we've balanced that out. But if we hop back into the handout real quick, I'll just highlight some of the reasons behind American Funds underperformance. And just our recommendation right now is to remain patient. I'll give you a little context to that. So page 10 is a highlight for the quarter. little bit deeper dive into their portfolio, what went right, what went wrong. More went wrong, obviously, than right for the quarter since they underperformed. But two of their biggest holdings that underperformed the index and really detracted from their portfolio. The first one, Novo Nordisk, which is one of the world's largest pharmaceutical companies. You might not know their name, but you know the name of a few of their drugs that have recently blown up and caused them to outperform over the past few years, but have led to their underperformance recently. Ozempic, Wegovy, and Rybelsus, those are all weight loss drugs or drugs used for secondary for diabetes, but actually work off brand as weight loss drugs. So the trend of those over the past 2 years has been, skyrocketing a lot of these pharmaceutical drugs, but with that has come competition. And so while they were first to market with Ozempic, a lot of competition has come in place, and so that's driven down their revenues. On top of that, in April, Trump announced potential tariffs on pharmaceutical imports, and so again, that weighed on their stock. On top of that, they had a new drug that combined kind of the best features of Ozempic and Rybelsus. It had underwhelming late-stage clinical trials, and so again, one of their potential home run drugs, poor clinical trials, weighed on the stock, so they sold off for the quarter. The other company that their second largest holding that underperformed, Taiwan Semiconductor. So you've probably heard the AI race right now. Who's going to win the arms race for AI? Well, part of that are the semiconductor chips that are provided for that. And so the current administration announced that they were considering new tariffs as well as export controls on Taiwan Semiconductor for national security purposes. So if they don't want China getting their hands on the latest and greatest chips, they want those just coming to the US so we can win that AI arms race. And so unfortunately, that negatively impacted Taiwan, because when you're having one of your largest customers cut off from your supply, again, that's going to impact your revenues and earnings at the end of the day. So with that, we can kind of wrap our hands around underperformance from a stock selection standpoint when we kind of have the background of which stocks underperform. So if we look on page 11, the reason we're recommending patience right now, it's no surprise through the pandemic, it's just been a very wonky market, and it's been very difficult for a lot of active managers to outperform. So you can see in this chart on page 11, underperformance since the end of 2020. American funds has pretty much been flat, down 0.1% compared to the benchmark at about 4%, ranked in the bottom 99th percentile. So essentially one of the worst performers over that time period. However, if we kind of take out the strangeness of the pandemic market cycle that we've been through, if you look at the previous 2 decades, so from 2010 to 2020, they were one of the best performing international managers. And you can see that in the middle of this chart, up 8% on average, up 2.5% on average over that decade over the benchmark on an annual basis. And even the decade prior to that, so 2000 to 2010, again, ranked in the top 7 percentile and outperformed its benchmark by nearly 1% on an annual basis. So again, we trust their process. We trust the portfolio managers there. We think it's been a very difficult market cycle for most active managers, not just American funds. And so we would expect them to rebound to those longer term trends of outperforming. So we're just recommending a little bit of patience with them. Again, you have 2/3 in the index right now, so it's not like they're significantly weighing down your portfolio. So no need to kind of carve away more of their portfolio. We've moved 2/3 of it to the index, but we're going to keep monitoring them on a quarterly basis. If their performance continues to deteriorate, then we would make a move, likely consolidate to the index, and then bring a search for some additional active managers if we do want to carve back some of the index to an active manager. But right now, we're just recommending patience with them. Again, we trust their process. Longer term numbers look great. It's been a strange market cycle, and we think that they can recover.
How long do you recommend that we be patient for?
Again, just quarter by quarter. So if they have another quarter like the current one, so if you go back to page 12 in the report where they missed the benchmark by over 4%, I think that would recommend moving more from them to the index. If they're close to the index or outperforming, again, we just take it quarter by quarter. We're not adding, I don't recommend adding any to them, like if they outperform next quarter, not adding back. But again, just taking it quarter by quarter. And if we see significant underperformance again, that would be grounds to move more away from them. And then other than that, page 13 just highlighted, again, fixed income had a great quarter, Sawgrass 3.1% outperforming the index. This is the third consecutive quarter we've had positive returns for real estate. So happy to see that. American Realty has done a good job there. I mentioned last quarter we had positive net absorption in commercial office for the first time. So 3.5 million square feet of office went occupied over vacant. So that's a good trend. Again, more people going back into the office is better overall for the private real estate market. So happy to see that. And again, cash continues to do well. So having that overweight there, over 1% for the quarter. So that money could have been allocated to equities, which again, were down between, 4 and 10% in the US. So happy to see that overweight, adding some value to the portfolio. Again, other than that, no recommendations. It's been a very difficult market to allocate money, again, just because of the uncertainty. As we get more certainty, markets like that, your portfolio will appreciate that as well. So hopefully we can see some more of those trade deals come through over the coming weeks, especially with the EU, obviously a huge trade partner. And then if we can get a permanent trade deal with China, again, the 35% is just temporary. We can get something permanent there. I think that's a huge tailwind to markets going forward. So with that, I will conclude my report. Just open it up to any questions or discussions.
Any questions, Mr. Brand?
Good. Somebody
Make a motion to accept the BCA report.
A motion by Sugden
Second.
and a second by Leonard to accept the report. All in favor?
Aye.
Thank you, sir.
Thank you.
Oh, next is Mr. Perry. Miss Ann, are you there?
Can you hear me?
Yes, ma'am.
Hi, I hope everybody is well. At our last meeting, we discussed adding an ordinance to allow for a partial lump sum option. That day of our meeting, we did not have a quorum for the other two boards. So those boards met pretty recently, and we discussed putting that option into their plan as well. So at the conclusion of those meetings, I spoke with Patrick. He approved this language, and this is a draft of that ordinance. Pretty simple, just adds in the lump sum options in with the other optional benefit forms. I have asked Patrick to draft a statement basically saying that this will not cost the plan any money, an actuarial impact statement. He probably has not completed that yet. It was pretty recent that I submitted that request, but we are moving forward, and we should be able to send this in to the city clerk pretty soon, once I get that from Patrick.
Anna,
Yes.
I have the ordinance for the general plan up on the screen that Virginia is sharing. I
Okay,
will
great.
send a copy of this to the board to have them look at once you provide each one of the plans.
Okay.
Thank you.
Miss Anna, will anything change between this portion for general and us?
It should not. This was just I apologize. I did one first. The language is the same. The intro to it might be a little different. I can send the one that has all three plans in it. I just didn't want to do it 3 times and then have Patrick have an issue with the language and then change it. So of course, all the time was split between the 3 plans, just trying to make it as effective for everybody. But the language that you see being added is exactly the same. So if you have any questions or comments on that, that can certainly be discussed now. Nothing is going to change unless, of course, you all have any issues or you'd like anything changed.
At some point, Ms. Carl, will Patrick be able to give us?
Yes. He just recently received the request to do the impact letter, and once that's completed, he will send it. I can send the draft ordinance to you all to take a look at.
So, right, just so that there's no confusion, the draft ordinance will have three separate sections that will address the changes for all three parts of the plan. We thought it just made sense to do one ordinance and put all the changes into one.
Right, it shows the different percentages from 5 to 20 gradual going through, but, once this goes through, it has to go to the commission to be approved to see, and if there's no impact, which we assume there won't be an impact to the plan, it shouldn't be an issue.
When will you be Patrick, give us a class on how all this will work?
He will be here for next meeting, so we'll put it on the agenda for that. How will that work?
Thank you.
Thank you.
Yeah, we need to be cautious of with this new ordinance. Is there something we need to be paying attention to? Is there reason to be leery of this or?
No, from what we understand, it's, it should be a no cost item. There shouldn't really be any issues with it going through city council to be passed. I don't anticipate any issues at all. I'm
My
actually
only
doing this.
concern, I'm sorry, my
Oh,
only
no, go ahead.
concern is the training for the members, that they understand the effect this will have on them. By doing this, remember Patrick said, a pension is your lifetime benefit.
Right.
And by taking something as large, 20% of your benefit, which will be taxable, it's, raised up the cost flag. So it's the education of the members that we want them to understand.
And we can certainly, myself and Patrick maybe come up with a cover letter of some sort that could be sent out to the members saying, just want you all to be aware, this is a new option. Of course, once it's passed, we'll do this. Just be aware that, like you said, this benefit, is a lifetime benefit and 20% is a significant amount. Of course, before anything, we advise you to, consult with tax or financial advisors, something like that, just to kind of give them a heads up that it's available, but it's something, that they should be cautious about choosing one of those larger numbers.
Another Form 1 memo is up there for you.
Okay, sorry, you guys froze a little bit. The Form 1, just a reminder to get that in by July 1. The form must be filled out online. Going forward, from what I understand, once you fill out the form one time, the next time you go to do it, the information should auto-populate. So that should be nice going forward. But if you have any questions, please feel free to email me and I can help you get what you need.
Thank you. You have anything else for us?
That's it.
Thank you.
Thank you. The conference list for the 2025, it's a 2-page document, is in here. I'm trying to encourage everyone to think about going to a conference, if not this year, by next year, you'll be accustomed to seeing these lists. And my encouragement to attend conferences for some educational trustees and also meeting with trustees from other plans.
We want to come out of that fall trustee school.
Let's see.
Is there any reason to take a conference with that?
I'm sorry, again, the question?
We were thinking about going to the 2025 trustee school in Sawgrass.
Okay.
Would you prefer for us to take a conference over?
I think for if the last one you went to was it a PPTA? Because that's, we have to register in the plan. What is the membership? There's a cost of about $750 to be a member of the PPTA. And if you're like that, they will give us a reduction usually for half the year or lower part of the year if you want. We do it for 6 months and then you can register for that. That's a very good trustee school, but it's an intensive. So, that. For they check you in, exams for people doing certain things, so it's more intensive. The conference is more listening to a speaker, talking about their latest book, telling what's happening. And it's great to socialize with other trustees from other plans. So that's the difference between the school conference.
That would be a one-time fee to the plan, not for each of them.
Correct, correct. There's a one-time fee that's a membership fee, and every person who signs up to go to the event or school, there's a fee for them, a hotel. But the place is willing to pay for them, I'm sure.
Thanks.
The next item I have is from Foster and Foster. This is just letting you know that FRS has changed their mortality rates. The good news is the life expectancy has gone up, which is good news. But which means there's going to be a change that we have to adopt for evaluation next year. It's better to do it as soon as the package is for the following year. So that's for next year.
And there will be some impact to the pension, I'm certain.
Yes, yes, of course. The last meeting, we approved the valuation about what we need to do now is that these new rates of each other. What based on the advice of the consultants, the plan expects to receive a 7.4% rate of return for the next year, the next several years, and the return thereafter. It sounds great.
I'll accept the motion. One of you will need to make a motion.
Gonna make a motion to accept the assumption rate of 7.4% rate of return.
A motion by Sugden to accept the advice of Mark. Second rate of return, and a second by Lindy. All in favor? Aye.
Thank you. That's all I have, Chair.
Thank you, ma'am. You want to go quarterly expenditure?
In your packet, you have the handouts that are your fiduciary net position, the changes, and these are both unaudited. These are for your information to see where we are today, year to go, and what's like. What's changed. Following that for the distributions, there's a listing of the members that were paid out. And then following that. And everything is paid finally, everything's been working great. Thank you. A motion from the other meetings are to be received and funded.
Make a motion to approve the warrants.
A motion by Sugden to approve the warrants,
Second.
and a second by Lindy. All in favor?
Aye.
No.
Now we're on public comment.
Yes, sir.
Mr. Jones, have you seen anything on the public comment?
I did not receive any emails for comment.
Anyone here for public comment? Close public comment. On to other business. One discussion. And Ms. Cox had the benefit reduction or retirees, correct?
Correct. The last time we met, Patrick informed us that 2023, the pension payments should have been reduced, and they were not at that time. We were going to come with starting later on this year, but we didn't realize that they were put in immediately. So we got some pushback from some retirees that were very surprised that their pension payments dropped 1% significantly, the rest of them just moderately. And they continue to be this lower amount, which is what they should have been back in 2023, but they were dropped recently, and that starts over time, the pension payments will go up as a result of last year's fluctuating multiplier that was such a big fantastic year. But as we said previously, this is what we're trying to do, have the steady multiplier fixed. So there is no up and down for the pension payments. So you were to check for free. There was pushback on it. We had some happy members and now there's in October when it goes back up, but like we come to our next workshop, we're going to do a free, but it's going to until we got this straight down with the multiplier.
Did you want to say anything?
No.
Yeah. So how long will they'll suffer through this? They'll see an uptick in their payment in October, but how long will they suffer? Well, are they, in other words, do they have years of back pay that they have to suffer with?
No, we're not gonna go back and claw any money back. We just adjusted them from that point on until October, and then we'll go back in. But that comes through without us knowing about it and preparing the membership was upset. So we don't apologize. We don't, we're sorry. There was a miscommunication, but it's now gone through, and it will go back a little bit in October, and hopefully we'll get a workshop together here if the membership wants the fixed multiplier, which I'm hoping to do, and then don't have to go through this again with the up and down. But especially markets are very volatile.
Yes, ma'am. And then so Patrick will be able to help us with the plot discussion next meeting.
That's correct. He will be here, and that'll be on the agenda.
And then we will set a workshop for should we fix this rate? We'll be able to set a multiplier to discuss that with everybody.
Would you like to have a workshop, the scheduled date of the next meeting, which is August 26th?
I don't think it will do us any good if we're not passed through the commission yet. If these things haven't gone through the commission, we'll workshop have done us any good.
Well, we need to have the membership tell us if they want a fixed multiplier. That's the feedback we're looking for.
Then I think we should. I think we should have a meeting.
Do a workshop on the same day as we did previously in August.
That way everybody's clear about what we're trying to accomplish.
Very good. I will set one up.
Thank you.
And that's what I have done. Thank you.
You have any other business? I had one more question about the website and the portal, the idea of a portal and those things we talked about before. Our members being able to access account information or portal information.
I do have a beta for the Fires website that I can show you after the meeting. And Miss Virginia Jones and I are negotiating since we just started getting the payroll information.
Fantastic. Any further? Dash? All right.
I make motion to adjourn.
A motion by Mr. Lindsey, and a second by Mr. Secretary. All in favor? All right.
No.
Thank you.
Thanks, everyone.
Thank you.